Okay, hi everyone. This is going to be the video for chapter 3. What are we talking about here in chapter 3? Right, well, we're really looking at tax planning strategies. Hey, you've learned about the rules of the game, the setup of, for example, the 1040. Now, what is the strategy associated with that? And in this way, right, the basic goal is going to be that we want to maximize the taxpayers' after tax wealth, right? So the idea, hey, whatever is your take home, right, after you pay taxes, whatever you have left, that after tax wealth, that's the goal. And we do have to balance this, of course, against any non tax goals. So, by way of example, maybe you have a son or daughter who is disabled, right? Yeah, it's like one thing to look at like the tax items of saving for them. It's another of just having that non-tax goal of taking care of your child, right? Are we doing that? So there are various things here. So whenever you have a client who comes in, right, you need to understand first, what are we doing? We're trying to basically save them in taxes. And what are sort of their personal preferences or personal goals? Are they maybe perhaps like more stable? Are they risk adverse? How does this kind of all shake out? So, when we're talking about tax strategy for planning, right, you really have one of three ways that you can accomplish this. One, through timing, right? So, you can time whenever you recognize, that is to say, put on your tax return any income or deductions. The general rule here is going to be that you want to defer income, so push it out until a later point in time, and accelerate, take as soon as possible, any tax deductions. Okay, now there are some variations with this, right? It depends if we have constant increasing or decreasing tax rates, and we do have to be aware of the fact that the time value of money, namely like present value, future value, that does come into play whenever we apply timing strategy. The second strategy here, and again, this is at a high level, is income shifting. Traditionally, where are you going to see this? Right? Well, it will be between really a high tax rate and a low tax rate. So, for example, between family members, right? Maybe you have like Mr. Monopoly who's very rich. He wants to transfer income to Monopoly Junior, who is like a baby, right? So maybe Mr. Monopoly's in the 37% tax bracket, but Monopoly Junior's in the zero, right? So he tries to shift that income down there. There are some limitations with that we'll talk about. So that's like kind of one flavor of it. Another way you can shift income is in tax jurisdictions, right? Shift from a high tax jurisdiction to a low tax jurisdiction. And this can be done on a country basis or a state basis, right? So when I was in practice at Deloitte doing national tax, one thing that was like very common, and they tried to sort of combat this in the TCJA, is the offshoring of income. Right, we're going to park those earnings overseas. Have it maybe potentially be taxed in the foreign country. That will be taxed at a lower rate than the U.S. And really, anytime you're dealing with international, it's a big cost benefit analysis. Like, are we subject to these provisions? If we are, does it make more sense to comply with them or not? We'll talk about that potentially in other chapters if we get to the international chapter. But that's kind of one flavor, shifting it like inter-country. It can also be intra-country, right? So, hey, maybe you have income from a S corp, right? And you would say, how do we want to break this out when it flows through at the state level? We're going to say more of this is sourced to one state or another. Obviously, right, you have to meet all legal requirements, but the idea here is, hey, states tax things differently, so maybe we can try to shift some income or expenses accordingly. Finally, here, conversion, a third strategy. This would be converting income from high to low rate activities. So, what are some examples here? Well, a classic one might be muni bond interest, right? So maybe instead of having regular taxable income, right, investing in the stock markets, maybe you might consider investing in muni bonds. Those are going to be exempt do not have to pay tax on them at the federal level. Likewise, another kind of conversion, right, if you were shifting the income, could be like maybe going from an ordinary capital gain to a long-term capital gain. So the line of demarcation there is like 1 year, right? Maybe you have a policy or a procedure in place that we're going to hold all of our appreciated assets until that 1 year mark so we can convert it from ordinary income to long-term capital gain income, get that preferential tax rate in that way. All right, so these are kind of high level. Let's start with timing strategies. Okay, so as I have here, the taxation of income relates to the time value of money and potential changes in tax rates. So when we're talking about the time value of money, you probably have seen this before in maybe like a financial accounting class. Sort of the underlying theme with it is a dollar today is worth more than a dollar tomorrow. Why is that the case? Well, hey, you could invest that dollar today such that it would be worth more than a dollar tomorrow, right? So if I gave you $100 and I was like, I can give it to you today $100, or I can give it to you tomorrow $100, you should say today, because hey, maybe you take that $100, you throw it in the stock market, and tomorrow it's worth $120, right? So that's the idea of the time value of money. Money makes money, right? You can have interest, right? You can have stock appreciation. And generally, how we're going to categorize this is it will be known as the discount rate. You can kind of think of that as the functional equivalent of like the open rate that's on the market, what you would earn as a percentage on your investments. So when we're talking about time value of money, it kind of breaks down again into future value and present value. So what does that mean? Well, when we're talking about future value, it's really saying, can you please tell me what a present amount of money is going to be worth in the future? Right? So you can think of this like a bank account, right? If you got $1,000 in your bank account, it earns, X percentage per year. If I came up to you and I said, what would that be worth, your bank account? What's your balance in 3 years? Well, you'd have to figure out, kind of compound the interest, add it to the principal. There you go, right? It's the future value of a present amount, what's currently in your bank account. Now, when we're calculating future value, there's kind of a couple of different ways you can do it. There's a formula, there's present value tables. You could potentially use Excel or some other kind of like programming. But if we start at it, right, with just this sort of like mathematical formula, the future value is going to equal the present value times 1 plus r to the n, right, where r equals the after-tax rate of return and n equals the investment period. So if we look at this example here, right, so it says, for example, if there's a 5% after-tax rate of return, and then $100 today will be worth $105 from 1 year from now. And as I have here, thus, if a business received a payment from a customer, namely a cash inflow of $105 from 1 year from now, that's effectively like receiving $100 today, right? So we're looking at an amount here, right? $100. What's it worth? Oops, going off track there. In the future, right? So this is kind of like Back to the Future 2, where they go like to the future, right? We're going there. On the flip side, right, we have the present value. And when we talk about the present value, really you're taking an amount in the future and you're shrinking it down to its present value in today's dollars. So maybe a simple example, right, a very common sort of trend or theme is if you want to retire, you got to have $1 million in your 401k, right, like saved up for retirement. Now, if that's the case, right, $1 million, and I came up to you and I was like, being very generous, right, and I had the funds to do this, and I said, hey, I can give you a lump sum today, and I want you to tell me the exact amount to give such that in 40 years when you retire, you'll have $1 million, right? So this is the idea of present value. We're taking a future amount, $1 million, and shrinking it down to today's worth in light of the fact of the time value of money, right? So hey, maybe it's 400,000, right? When we compound that year over year with the interest rate there, it'll ultimately grow to $1 million. And when we talk about present value, really what it is here is the future value equation rearranged, but it's going to equal your future value divided by 1 plus r to the n. Right, so if we look at an example over here, um, it says, so for example, if there's a 5% after-tax rate of return, then $105 from 1 year from now is worth 100 in today's money. Thus, if a business makes a payment to a customer, a cash outflow, so last time it was an inflow, this time it's an outflow, of 105 1 year from now, that would effectively be like paying $100 in today's money, right? So here, we're kind of like Back to the Future 1, right? We're like in 1986 and we're going back to 1955. I don't know when the movie's set, but they definitely go from the 80s to the 50s there. All right. So in those two situations, when we talked about the time value of money, present value, future value, we really looked at it there with that little sort of calculation. You can also use the present value table. And on the exam, right, I may give you the present value table and you may have to kind of like battleship this and figure out what the amount is, right? So let's hop over and look at a couple problems here. Right, so here's 3-1. It says, hey, Bill is given the choice of receiving a $1,000 non-taxable gift today or a $1,000 non-taxable gift in 1 year. Which one should he prefer? Assume Bill could invest the $1,000 today and earn an 8% return after taxes in 1 year. If he receives the gift today, how much would the $1,000 be worth in 1 year? Sorry, I drank a little too much coffee. I have like acid reflux here. So the idea with this is the $1,000 gift today would be worth $1,080 in 1 year, and for this reason, Bill should prefer the gift to receive it today, right? So here we're kind of showing you the math on it. So it's like almost like giving you a choice. When do you want to get it? Now or later? All right, 3-2 here. Right here we're looking at the little table, right? How do you use this table? So at a recent holiday sale, Bill and Mercedes purchased $1,000 worth of furniture with no money down and no payments for 1 year. How much money is this deal really worth? Assume their after-tax rate of return on investments is 10%. Okay, so what we need to do here is, okay, we're going to start up here. We're going to go to the right. Oh, we're looking at 10%. Right? And in this way, they're saying, how much is it worth? Let's see. They want to know no money down and no payments for 1 year, right? So we'll do 1 year, 10%. It looks like the discount factor here is 0.909. What we then do is, right, we'll take that $1,000, right, purchase the $1,000 worth of furniture, multiply it times 0.909. It equals $909, right? So in this way, Bill and Mercedes saved 91 bucks, right? The 1,000 minus 909 there. So continuing, right? Kind of looking at this. So how does this time value of money come into play with taxes, right? Because they seem a little bit like mutually exclusive right off the bat, right? Like, hey, I see this in my finance class a lot. How does this have to do with taxes? Well, when we're talking about taxes, the general rule is going to be that tax planning prefers higher present values for cash inflows, which are going to include tax savings generated by deductions. And when you kind of analyze that, right, taxpayers should normally accelerate deductions. In other words, a deduction today has a higher present value than a deduction for the same amount in the future. And really what we're talking about here is you can think of like a deduction as like reducing your taxable income, which reduces your tax liability. If you have less tax liability, that's less tax you have to pay. So if you take that logic chain and kind of compress it, you can really say that a deduction is effectively a cash inflow because it saves you from paying taxes. Now, as I have here, similar, tax planning generally prefers lower present values for cash outflows, including taxes paid. So For this reason, taxpayers should normally defer income as future taxes paid on the income have a lower present value than taxes paid today on the income. So really what they're saying here is, given this time value of money setup as well as cash inflows and cash outflows, we're generally going to want to accelerate deductions, take them as quickly as possible, and defer reporting income, right? So if we look at this here, Smith can take a deduction of $100 today or $100 from 1 year from now. Assume the present value of a deduction 1 year from now is $80. Based on these facts, Smith should take the deduction today because it has a higher present value than the deduction 1 year from now, right? So today it's worth $100. When we take the amount in the future and we shrink it down into today's dollars, it's $80, right? So we're kind of looking at this right here. We want higher present values here. 100 present value is bigger than 80. Therefore, we take that deduction today. In distinction, right, we have the flip side down here. Smith can report income of $100 today or $100 from 1 year from now. Assume the present value of the income of 1 year from now is $75. Based on these facts, Smith should report the income 1 year from now, defer the income, and as it has a lower present value than reporting the income today, right? So 75 1 year from now is less than $100 today. And that's what this is saying up here. When we're talking about income, right, which will ultimately result in taxes paid, we want lower present value. So here's 75 versus 100. 75 is lower. That's the one we're going to pick. And for this reason, right, we want to report the income from 1 year from now. That gets us to the 75. So when we're talking about kind of tax planning strategies, do be aware that it kind of depends on what the situation and the setup is. First off, it's client specific. So there's not always it must be this way, right? It really depends on the needs and demands of your client, what their income is, what state they live in, what are the associated tax rates, right? There's like a lot of variables that come into play for this. But if we were to sort of summarize it in a general rule, right? Overall, right, there's really one of three things that can be going on with the tax rates, right? So you can have constant tax rates, you can have increasing tax rates, or you can have decreasing tax rates. And the strategy, right, the general strategy is going to be the same if it's constant or decreasing. That is to say, you're going to accelerate your tax deductions, right? Do those deductions now, and defer your income. And most of the time, right, if there was like, if you go up to the average tax person, this is like probably what they would tell you when they say tax planning, right? You always want to accelerate the deductions and defer the income. When we have increasing tax rates, then, oh, sorry, I'm flipping off screen here. We kind of have to do a cost benefit analysis. Sorry, I'm taking forever. I got a little trackball here, so it's hard to look at that. And we'll look at this here, but they will give us rules for if, in light of the increasing tax rates, we should recognize a deduction or defer the income. So we talked about, okay, we have three different types of tax rates, constant, increasing, or decreasing. Two of them have the same strategy. One of them is a cost-benefit analysis. How do we get in a situation, or what can cause the tax rates to go up or down, constant, decreasing? Like, how does that actually happen? Well, there's really a couple different scenarios, right? So one thing might be is that a taxpayer in 1 year to the next is going to have a really big income increase, right? Maybe you're in the 15% bracket this year, and in year two, you win the lottery and you get $1 million, right? So you're going from like the 15% tax bracket to the 37%. Or alternatively, right? Maybe it's you get a big promotion next year, right? Hey, you hit manager at the CPA firm, you're going to now be making 6 figures. Your tax bracket's going to go up. We got a plan for that. It does go the reverse way, right? In the sense like you lose your job, you get fired. But there's like various reasons there's kind of like personal. In addition to that kind of personal configuration, you can also have changing tax rates from a statutory level, right? So by way of example, the TCJA, the Tax Cuts and Jobs Act, aka Donald Trump tax reform, 2016, 2017, they had a lot of individual provisions in there. Like they gutted a lot of the itemized deductions and changed some of the tax rates. But many of those in the next few years, right, like 2025, 2026, they are going to go away. And when they go away, right, we're going to have changing tax rates. So that's like one scenario there legislatively. So and it does cut both ways there in the same way, like with your income going up and income going down, the legislation can affect proactively and retroactively. So proactively, whenever they originally had tax reform, there was a little bit of a buffer period before it kicked in. So you had to account for the changing tax rates in light of them going down because of tax reform. On the back end, when those provisions kind of sunset, it cuts the opposite way. It's changing tax rates being restored back to the higher tax rates. All right, so let's look at constant rates here, and then we'll kind of break it here because that's a little bit about halfway through the PowerPoint. So constant rates, right? I have like Groundhog's Day here. If you've ever seen that movie, right? He like wakes up, it's the same thing over and over. That's what we mean when we're talking about constant tax rates. It's really like we're expecting from one year to the next, it's going to be the same, the same. How do we deal with this here? All right, so the idea with it is taxes paid are going to be considered a cash outflow. And as I have here, taxes saved are going to be a cash inflow. That makes sense, right? You pay taxes, it's going to cost you cash, right? You could actually mail that into the IRS. And to the extent you save, right, maybe through a deduction, you won't have to pay that tax. So it's effectively a cash inflow. So in this framework, if we have constant tax rates, right, it's like 20% in year one, 20% in year two, right, things, we have a relatively same level of income from year to year, like the legislature is like going to be the same, then this is where we're going to follow that general rule of accelerating tax deduction. So try to deduct now, and defer recognizing the taxable income there. Kick the can on it. Defer. Really, what this approach does is, right, whenever you kind of look at it from an inflow-outflow perspective, is it's going to maximize your inflows and defer your cash outflows, right? So that's kind of what's going on there. And this is just another way of kind of showing this here, right? So as I have here, accelerating tax deductions and deferring recognizable tax and deferring recognizing taxable income both help to defer cash outflows. That is, a deduction now has a higher present value than the same deduction later. And conversely, recognizing income later decreases the present value of the tax liability paid associated with that income. So that's kind of going back to, where were we at here on this? Oh, yep, right here. Sorry, I'm staring at it right in front of us, right? So that's just kind of applying it to this guy right here, right? Whenever you see those inflows, outflows, present values. So let's look at an example here, and then we'll kind of wrap up this lecture. We have Smith. He's single. He's considering purchasing an asset for 10 grand that he'll immediately expense under section 179. So what does this mean? Right, he's going to get a deduction. Damn it. Going off screen here. This track mouse is not the greatest for giving lectures. So 179, a deduction. Hey, I want to buy something and I want to immediately expense it. They're saying here, what is the after-tax cost of the asset if he purchased it in year one or year two? Assume a 20% marginal tax rate, right? So we're looking at 20% in year one, 20% in year two. They're equal, right? So it's a constant tax rate. And then they're telling us that he has an after-tax rate of return of 8%, assume the present value of the discount factor for one period at 8% is 0.926, and that the future value discount factor for one period at 8% is 1.08. All right, so they're giving us some information, high level, what's going on here. Hey, I want to buy a machine, right? I want to know, should I buy it in year one or should I buy it in year two? It's basically a framework here of saying, should I take an expense now or should I take it later? And we'll see, right? The general rule here with constant tax rates is take it now. So then they give you the present value stuff, right? So this is another way you could see this on the exam or in the homework. Instead of actually calculating the factor or using the table there, I could give you the information, right? So here it's like they're giving a little too much. You need to be able to pluck out in this situation, right, the 0.926, right? That's what they use over here. So when you run the numbers on it, right? So the deduction in year one, 10,000 bucks, 20% tax rate, we save $2,000. The discount factor here is 1, right? If you're doing it right now, right, it's 1. So it's going to be savings of $2,000. You paid 10 for it, you save $2,000. Hey, this thing after we consider the tax implications is going to cost us 8. In distinction over here, right, if we do it next year, right, so we get the $2,000 deduction, but the discount factor here is going to be 0.926. So we multiply it, that's 1852. So we do the 10 grand minus 1852, 8148, right? So at the end of the day, really, right, what they're saying here is you should take the deduction now, right? By doing that, you'll get a bigger present value of tax savings, and in turn, the machine is going to cost you less. Another way to think about this, if I came up to you and I would say, would you rather spend $8,000 on a machine or 8148? It's the same exact thing, right? All day, every day, you're going to say, $8,000. It's lower cost. So we're going to pause it there on it. We'll pick it up with some kind of changing tax rates, giving it some numbers. But this is sort of the first lecture, and we'll go from this point in time.